So for the last two speakers gave us the perspective of local companies in the emerging markets, and now we're going to turn to US companies. And the first company we're going to look at is a fund manager, Wellington Management. And then we're going to look at Procter & Gamble. And then we're going to look at a whole series of companies, US companies operating in Africa. So that's the plan for the rest of the morning. To look at portfolio investment in these emerging markets and what does that mean for investors given the volatility in these markets. We are delighted to have Ashish Chugh, who is managing director at Bay Pond Partners, which is a hedge fund managing, I think, $6 billion. And he tells me that out of that, $2 billion is in the emerging markets. And the Wellington Management Group as a whole has about $900 billion of assets under management. So it's a very, very large company and also an employer of many of our students as co-ops and even after they graduate. Ashish has an MBA from Harvard Business School. He graduated 13 years ago. He's been in the industry since, moved to a few different positions along the way. And after a career in IBM, and once an engineer, but now a finance person, he's just come back from China, I think yesterday or the day before. I got his slides at 3 a.m. So appreciate that, Ashish. And I'm very grateful that you've still managed to be here with us. So please join me in welcoming Ashish Chugh.
So if I'm incoherent, you can understand why. It's because I'm jet-lagged. So I thought for this presentation, I would give you an idea about the emerging market equities, so essentially stocks in emerging markets and how they have fared and why these markets have done what they've done over the past few years and what the prognosis might be, what we're thinking of these markets looking forward. So emerging markets, as I'm sure you guys know, are officially, as MSCI defines it, is 23 countries. And most of them are in Asia, but they're essentially spread all over the world. And so we invest in all of these countries as portfolio investors. So directly in stocks of companies, just like you would buy stock here in Apple, we buy stocks in these countries in various companies. So if you look at this slide, it basically shows how emerging markets have done over the past 15 years. So the blue chart is the MSCI Emerging Markets Index. So that's the broad-based index that reflects how the emerging market stock markets of the 23 countries. And the other two graphs there are MSCI ACWI, which is the all-country world index. So it's a very broad-based index, and ACWI IMI, which is an even broader index. So it shows that emerging market stock markets have done really well since 2001 when they sort of came into fashion. But if you look at this top graph of MSCI EM, there are really three different sections to it. So there's the section from May 2001, the beginning, till the global financial crisis, which was up till end of 2008. Then the second section is from 2008 to 2011, and the third section is from 2011 onwards to today. And so you can see that the stock markets in EM did really well from 2001 to 2008, and that was really because it was an unprecedented time in global economy. So the rising tide was lifting all boats. It was essentially a time when pretty much all countries in the world were experiencing positive growth, and emerging markets much more so because they were starting off of a low base and there was a lot of underpenetration. And so that was also the time when you had zero, almost very low interest rates in the US. So post the tech bubble bursting, there was monetary easing in the US and interest rates were very low. And there was a lot of liquidity, and this liquidity was essentially trying to find a home. It was essentially trying to find returns. Emerging markets were giving very high yields. Their bonds were giving very high yields. These countries were reforming. They were coming out and opening up their markets. And so this was a natural place for getting all this money, for taking in all this money because of the returns it was providing to investors. And so emerging market stock markets did really well. It was a big bull run up till the global financial crisis. But once the financial crisis happened, it sort of demonstrated that these emerging markets are not decoupled, that that these markets are coupled with the US. And the main linkage was, of course, that capital that came in from the US and developed world into the emerging markets. And that capital had to be withdrawn because the banks and the companies in the US were deleveraging, and they needed that money back. And so a lot of that money came out of the stock markets. And so you had that massive fall in 2008. And that also led to a slowing down of the economy because capital basically got withdrawn. And most of these countries were capital constrained. And so what then happened between 2008 and 2011 was these countries, the governments of these countries basically wanted to stimulate the economy in order to get growth again. And so they did that by monetary easing, by lowering interest rates. They also did that by expanding their balance sheets, the government's balance sheets. And so used basically the Treasury issued bonds to basically invest in infrastructure and invest in all sorts of things. In the case of India, a lot of it was power. In the case of China, it was real estate and infrastructure. In the case of Brazil, it was the oil and gas sector, the consumer, SMEs. So they basically stimulated the economy by unleashing credit. And a lot of that was through their own balance sheet, but a lot of that also was through the public sector banks. And so the public sector banks basically started lending, and that stimulated the economy, it created growth, and emerging market stock markets did really well because you were back again in a growth phase. So that was 2008 to 2011. And then since 2011, you can see they haven't really done much. They have really come down, and they've delivered negative returns. And the reason is that stimulus could only go so far. You can't really continue to stimulate. Basically, you're expanding the debt, the country's debt, in order to do so. And you're also, by creating all this liquidity, you're generating inflation. And so there was a limit to how much stimulus could be provided. And so that basically unveiled a lot of the weaknesses of the emerging markets. You could no longer depend on cheap and easy money to drive the economies. You had to basically have fundamental drivers that drove the economies. And a lot of these countries really didn't invest in productivity enhancing drivers for growth during the boom phase. So, from 2001 to 2008, there was a lot of this wealth creation, but say countries like Brazil, for instance, which were major commodity exporters, didn't really create a whole new set of industries to wean themselves off of commodity exports. They didn't increase productivity by investing in education. They didn't increase productivity by investing in infrastructure. And so a lot of those weaknesses came to the fore, and that basically those became bottlenecks for growth. And so that was one of the main reasons why emerging markets have not done as well over the last 5 years. And especially if you look at the next slide, this basically shows the light blue line is basically showing how emerging markets have done over the last 5 years on an absolute sense. So the line is obviously going down. If you invested in just the index, you would have lost money. But more importantly, what's really interesting is they've actually done really bad compared to developed markets. And so this is quite interesting because the common perception was that emerging markets are the place where you make a lot of money if you're a stock investor because there's a lot of growth there. But that's not necessarily true. And it's in general, in stock markets, it's very true. There's cycles, and emerging markets obviously went through their bad cycle in the last 5 years. So what was the reason? So basically, you can try to sort of go deeper into figuring out, well, what were the reasons why over the last 5 years these markets haven't done well, the stock markets? There's these macro reasons, but what are the underlying fundamental reasons that has caused these stock markets to go down? And one of the main ones is what drives stocks, as I'm sure you guys know, is earnings, is profits of these companies. And the earnings growth for emerging markets slowed down considerably for the emerging market companies, and it became more inferior to the developed market companies. And so for 20 straight months, this has been the case, and this is the longest stretch of underperformance of earnings since the Asian financial crisis, so going back to the late 90s. And this basically represents the weakest growth of emerging market earnings, so not relative to developed markets, but just in their own right since third quarter of 2002. So earnings have gotten depressed significantly. If you look at the next slide, this basically shows at a higher level what has happened to these emerging markets in terms of GDP. So the solid blue line essentially shows the GDP growth differential. So the difference between emerging market GDP growth and developed market GDP growth. And it's common sense that emerging market GDP growth would be higher than developed market GDP growth. But what has really happened to that difference over time? And you can see that, in 2010, that difference peaked. It was almost at 7.5%. That's the peak of the solid blue line. And that has now come down significantly over the last few years, and it's sort of bottoming out at about 2 to 3%. And that's been the lowest differential since, I think, since 20. So yeah, it's for a long time. I mean, almost 10 years. And you can see the light blue line is essentially the emerging market stock market relative to developed market. So essentially, as you can see, these are pretty correlated. The GDP differentials of emerging versus developed, that differential versus the emerging market index relative to developed market index. So it's no surprise that as that differential got reduced, the performance of emerging market stock markets relative to their developed market counterparts went down significantly. And that's really what has happened over the last 5 years. And the IMF is basically forecasting that over the next few years, this differential will remain in the 2 to 3% range, which pretty much is at a decadal low. And so it doesn't bode well for significant outperformance of emerging markets over developed, just slightly, as we have seen in this chart. And so this is also another chart. It's basically telling the same story, which is this is just showing industrial production. Again, another economic metric that is sort of showing that over the last few years, industrial production of emerging markets relative to developed markets went down significantly. And again, there's a good correlation. The stock markets of emerging versus developed also didn't perform strongly as could have been predicted by looking at this historically. These are, again, a very similar slide. It's showing PMI, which is basically Purchasing Managers Index. This is essentially, this basically shows manufacturing activity in an economy. And so manufacturing activity and new orders fell significantly, and hence the stock markets also didn't do well relative to developed markets. It's the same. This is the Economic Surprise Index. So a lot of the similar patterns where a lot of macroeconomic data of emerging markets versus developed was weakening, and hence the stock markets also were basically reacting to that performance. And so you see actually in this chart, you see, over time, starting say 2 years ago, the GDP forecasts for all these countries started going down. So the 2014 line, the solid blue line, is the GDP forecast for 2014, made in January of 2014 throughout that year. The light blue line is 2015 GDP forecast, starting in that economists were making in Jan 14 all the way up till the end of 2015, and same in 2016. See, these forecasts are coming down, and these are basically, these are sort of economic analysts predicting GDP, and it's really, stock markets are a discounting mechanism, and so they look at what the prognosis and the predictions will be for the future of GDP, of earnings, essentially for companies, and then they basically discount that back to the present in terms of prices for stocks. And so all of this sort of is another factor. When you had negative revisions to GDP, you don't see them revising them up. All of them in each year were being revised down. So that was also negative for emerging market stock markets over the last 5 years. And then this is even more important. This is basically earnings revisions. So how are companies' earnings being revised by Wall Street analysts? And positive earnings revisions are great because they're projecting growth, earnings growth, which is really the driver for stock market returns. But here, as you can see, it was basically more and more negative earnings growth. And the breadth also was quite broad in terms of, it wasn't just one specific sector, it was a lot of sectors. And so the stock market performance accordingly was also quite negative. So this is a very interesting slide because it basically looks at FX as it relates to emerging market returns. And so the red line is really trade-weighted dollar, and the blue line is how the emerging market stock indices have done relative to the world. So it's basically comparing relative foreign current, or the relative value of the dollar. So that's what trade-weighted is, and then it's comparing the relative performance of the emerging markets index, and you see there's a big correlation. So even though most emerging markets have transitioned away from pegged currencies towards freely floating currencies, there's obviously an inverse relationship for almost 30 years between the trade-weighted dollar strength and emerging market performance relative to developed equities. And this is really the underlying factor for this, is why this matters and why the currencies are important. Well, one, because many of these emerging markets run structural current account deficits. So a lot of these countries that import commodities, like India, like Turkey, like Indonesia, they're basically running current account deficits, and because of that, that impacts their currency. And because it impacts their currency, it impacts stock market returns, because essentially most of the money is coming in from foreign markets, and they're looking for, in the case of Americans, US dollar returns. And so if you're not hedging the currency, and it's costly to hedge the currency, then you're essentially taking that risk on the currency. So you have to be comfortable with taking that risk, and because as this chart shows, your returns of your investments are very much correlated to how the currency does. And that's correlated to how your current account deficits are, that's correlated to what your debts are to external creditors, and many other things. So you have to basically be cognizant of these emerging market macro variables in order to figure out how you're going to make returns in these markets. The other reason why emerging markets did really poorly is because, as I mentioned earlier, the governments basically stimulated their economies. They took a lot of, by taking on a lot of debt on their balance sheets, and so their fiscal deficits ballooned. And that has an impact on company earnings, on stock market returns, because essentially what you're doing is if you're increasing the debt of the government's balance sheet, you're basically crowding out private investment. And because the government needs more and more money, and they will raise it at higher and higher yields. And that essentially is bad because interest rates will go up. And that chokes off growth. So what ended up happening is there was this stimulus that initially helped these countries, but then it eventually led to higher rates because of government borrowing, and that had the perverse effect of choking growth and slowing down these countries. And so you can see actually that over the last 5 years, most of them have been running, or the emerging markets as a collection have been running a fiscal deficit. And so, frankly, that's been one of the key reasons why the pendulum is now swinging the other way. So what happened 5 years ago, you had government stimulating the economy through their banks, public sector banks, and through their own balance sheets. But they could only do that for so much, and then growth slowed down. And so basically it caused a lot of unemployment. So people were happy when the government was stimulating, but once the stimulus went away, people were upset. And so it caused a lot of unemployment. It caused a lot of sort of imbalances in these economies. And so now what we're seeing is the pendulum is swinging the other side. So the socialist, the left-leaning policies of governments to subsidize, to stimulate, are now moving the other way. So we saw, this election in India where Prime Minister Modi really won on a platform of growth, of basically creating jobs, of stimulating the economy through private sector, not the public sector. Same thing happened in Brazil recently. The president over there is being impeached. The main reason is corruption, but the underlying discontent of the people is because unemployment is very high, because essentially they stimulated for so long and they couldn't stimulate anymore, and so people basically went to the streets, and that's really sort of the unintended consequences of stimulus, and essentially it leads to changes in government. So this is a slide that shows return on equity for emerging markets. So, so return on equity for emerging relative to developed markets, so that's basically the solid blue line, and then the light blue line is the price to book. So it's really a valuation metric that people use in order to value stocks and other assets. So you can see that 5 years ago, basically, or 6 years ago, the emerging markets ROEs have been pretty much in structural decline relative to the developed world. So just note that this is a relative, so it's emerging market ROEs over world market ROEs. So this is showing that they have actually come down relatively. And that's so they used to be almost 60% superior to world market ROEs, and now they're 5% inferior. That's a big change. And so subsequently, valuations have also come down. So what investors pay for stocks, they look at metrics like ROE, and so you will pay a lesser multiple for a lesser ROE business, a price-to-book multiple, that is. And so that's one of the reasons why emerging market stock markets have come down, because it's not just earnings have come down, but the valuation metrics, the multiples you use to put on those earnings to value the stocks have also depressed, deflated, because the returns you're getting has actually come down. And then the next slide is the point here, quick point. So you can see this is basically the solid blue line is developed market net income margin, so profit margins, and it's basically in the non-financial sector, so everything else except, say, banks. And the light blue line is emerging market non-financial sector profit margins. And you can see for the first time, in the not too distant past, the the net income margins for emerging markets have actually gone lower than developed markets. That's really something quite drastic. Over the history, going back to 95, they were always higher. So this is, again, one of the structural problems in emerging markets that is coming to the fore and that needs to be addressed. And this is, I think, one of the main reasons why emerging stock markets haven't done well, because China is the largest component of emerging market stock indices, and there's a big concern among investors about the problems in China. So China, you can see here, post the global financial crisis, really stepped it up in terms of stimulus. So it basically went vertical. So private sector to GDP is now 200%, or almost 33% higher than its 30-year trend. And this is the highest ratio than any major global economy. And people are worried, and rightly so, that all this credit that was unleashed in China is going to have maybe consequences similar to what we saw over here during the 2008 financial crisis, where a lot of that money went into real estate, into subprime, and basically blew up. People are worried that that might happen in China as well. And so this is a big sort of debate in the investment community. Is it going to be a hard landing? Is it going to be a soft landing in China? How will all this unfold? Will China become Chinese banks, which were used to stimulate the economy, will they become zombie banks like the Japanese banks did in the 90s when they had a boom and then a real estate bust? Or will these NPLs, non-performing loans, basically come to the fore, and the banks will have to sort of account for them? And that would mean that essentially, if you do some basic math, it basically means that the banks are bankrupt. And so will they recognize that problem, or will they just keep kicking the can down the road? So this is a very important question to answer, because China has been the biggest driver of growth and is basically connected to the emerging world, because a lot of the countries in Latin America and Middle East are exporting commodities to China, and so their fate depends on its fate. This is another sort of China slide that shows that residential property inventories are at 2.7 years worth of average sales. And this is, as you can see, very high. And again, a big concern about how this is all going to unfold. So, not to give you a finance class, this is basically, but the last line is the important one, which is, how do you figure out return on equity? Because basically what you're trying to do is you're trying to disaggregate, well, what is it in these numbers that is causing earnings to go down and return on equity to go down. And these are sort of for finance professors, this is sort of the DuPont formula. I'll quickly escape forward to that. And so this is basically showing the attribution of where is it that emerging markets are actually causing, what factors are causing ROEs to come down. And so if you look at the last few years, it's really FX and it's profit margins. So that in the next slide it becomes even more apparent. So all the red is profit margins that has caused ROEs to come down, and it's also FX, as we saw in the previous slide. And basically, so the question is, if these were the factors, then what is our prognosis for them going forward? So we actually think that these factors will get better, not worse, over time, because if you look at this slide, so it's showing that there's been a big differential between FX returns in EM versus in local currency, and this is like a 26% disconnect. So just going back to the earlier point that FX was a major variable, this sort of makes it very clear. And so the question is, well, what is the view on emerging market currencies relative to the US dollar? And we think that, that a lot of the dollar strength has already happened because, again, currency markets, like any other market, are discounting mechanisms. And the Fed tightening was very well telegraphed. And so what we have seen in previous instances when the Fed has started to hike is that you usually have a small period during which the currency appreciates and then it settles down. So you're pretty much, and starts to consolidate. So you're pretty much, I think, going through that phase right now. So emerging market currencies don't have much more in our minds as an asset class. It's different for each country, but as an asset class, probably not as much downside as they had performed over the last few years, and we're seeing that. So we're seeing, the Brazilian real strengthen. We're seeing many other emerging market currencies strengthen, not significantly, but certainly not being devalued. Let's see. And then the other reason is that the inflation differential is also important in figuring out FX, emerging market currencies versus developed market. What is the inflation differential between the emerging markets and developed markets? So that differential has actually been reducing. So emerging markets are prone to high inflation because they're very inefficient. Developed markets not so much. But what we're seeing now is emerging market inflation is coming down because growth has been down, because commodity prices have come down, because currencies have weakened, and the opposite is true of developed markets. So as that difference narrows, you have a subsequent strengthening of currencies relatively. And so that's another sort of supporting factor for why one of those factors that caused emerging market stock markets to underperform is actually reversing. So what's the time? Because I know you want me.
We're almost out.
Oh, sorry. So let me just open it up for questions. Sorry about that.
Yeah, we have a finance student. Go ahead.
Thank you for your speech. I'm a master's in finance candidate in Northeastern, and my question is that there's a significant capital outflow from the Latin American last year, and which result in the depreciation of the currencies in these countries. So can you give us some reasons behind of this phenomena, and where did these capital flow to?
Yeah, that's a good question. So one of the main reasons was, like, if you look at the largest emerging market country in the region, Brazil, so it got downgraded to junk. And so essentially the credit rating agencies looked at the country, looked at the country's finances, looked at a lot of different factors, growth, inflation, all these different factors to figure out what is the sovereign bond rating. And there was this big threat looming over Brazil that it's going to get downgraded to junk. And these rating agencies do give a significant amount of time for them to correct course to avoid that downgrade. But sometimes it's inevitable because you can't really change things. So that was the case in Brazil, that it got downgraded to junk. And a lot of money leading up to that left because Brazil gets a lot of money in its debt markets from foreigners, in its sovereign and corporate debt markets. And many of them cannot invest in anything that's not investment grade. Junk is not investment grade. So that was one reason. The other reason was people lost confidence in the Brazilian economy and other economies because in the region like Chile, Peru, Colombia, because they're very heavily commodity export-driven economies. And so if you have a negative view on China, you're basically tied to the hip to Latin American countries with that view. And essentially you're saying that these countries will also not do well, and so should we really invest in them? So that money left those countries, but it made its way in other areas which were riding their course. So India is a good example after its election happened. Indonesia also had an election with a very business-minded leader. And so these countries saw inflows of capital. And it also helped their currencies, and conversely, did not help the currencies of the Latin American countries.
Because we're almost out of time, I just want to distinguish between the different countries within the emerging markets group, because you've spoken about them as a class. So looking forward, for instance, India is growing at a faster rate than the average emerging economy. Does that, and based on your numbers, does that mean we should now be investing in the Indian stocks? So, or if not Indian, are there any other countries in particular at this juncture that you think are attractive possibilities? Because I'm sure some of us would like to go back and look at our portfolios and decide what to do.
Yeah, so certainly you mentioned India, certainly because a lot of the macro variables are in place. So certainly the government current account deficit has come in quite a bit because commodity prices have come down. They have done a very good job on managing the fiscal deficit. Interest rates are going down. They have a very strong team at the center. They have a very strong central bank governor. And then they're doing all the right things, at least in what they say. And then certainly some of that is actually coming into action in terms of reforms, and that will lead to eventually growth. But you can't, I would say, you can be a macro investor if you want and just blindly buy the Indian ETF or any other way you want to, or the Indian rupee. But that's completely different than buying individual stocks and companies. And so so there's lots of companies in India that are great that you can invest in, but of course you have to look at the valuations. But at the same time, there's a lot of companies that are actually very bad, that are publicly listed, that if you don't do your homework, you're going to get you're going to lose your money because they have poor corporate governance, or their earnings are bad, or they're in a bad sector, or they have bad managements. Doesn't mean that just because the country might be on a macro basis going to perform, that each company will do well as well. You have to then go further into your analysis to figure that out.
So we give you the money and you do that for us. All right. Okay. Thank you so much, Ashish.
Thank you.
Thank you.